Hey, good afternoon. This is May Valensky with Driving Markets, driving while talking about financial markets. Anything said in this piece is purely an opinion only. It's from media publications, not financial advice, not investment advice. Let's kick off. So the big question is, where are financial markets, where are equity markets going? Considering that you've had lower inflation over the last November period, reported on PPI and CPI. You've now got the Jerome Powell speech on Wednesday indicating that the Fed is going to take its foot off the gas. It's going to take its foot off the accelerator on increasing interest rates going forward. There will still be increases, as I've said previously, but they're going to be maybe at a lower level, probably December 50 basis points. Who knows what's going to happen in January? Now, if interest rates are not going to be or rising or be aggressive as they have been, then that is a good push for equity markets. However, equity markets or financial markets have already priced in all of the changes. They've already priced in a lower interest rate increase environment. So they've already priced in that interest rates are unlikely to rise a lot further going forward. So it looks like the equity markets could be fully valued. However, with lead up to the holiday period, what normally happens is that equity markets rise in anticipation of consumer spending and, of course, the good feel factor regarding the holiday period coming up to Christmas and Hanukkah, and also the other overall atmosphere within the home. It's a joyous period. People are happy and therefore they go out to spend. That's going to boost the profits of the retailers. So it's very well all set up that you could have a good year end to equity markets. Furthermore, it's in the interest of the traders, the banks and the corporates to have a good year end, because they were caught short in the beginning of the year with the rise in interest rates, rise in inflation and the Russia-Ukraine war. So you're likely to have a rising equity markets and a lower dollar on foreign exchange markets. Remember, the dollar is a safe haven and it's there to look at where you get a higher interest rate and there's uncertainty regarding economic outlook on the financials and global economics. So a rising equity market will push the dollar down. Now, just going on to a little bit on foreign exchange, what happened on the foreign exchange markets when once Jerome Powell spoke and he had another official indicator on inflation yesterday, that pushed down the dollar against the majors, against the euro, the pound, the yen, the Canadian dollar and Swiss franc, etc. Now, I'm a big fan of the pound, so I think the pound is going to go to 125, 127 in the near term. I'm not a big fan of euro, but if there's dollar weakness there, then you're going to have a bit of euro strength. So you could see the euro floating up to the 106.5, 107 level towards year end. Interestingly left, dollar yen. Now, dollar yen has come up because of dollar weakness, not because of yen strength. So the yen's come down to 133. Dollar yen's 133, could float down to 128 towards year end. And then I think there's going to be a big change in January. I think equity markets are going to be sold off significantly. I think we're going to have a dramatic turnaround. And I don't believe inflation is over. And I think there's some surprises waiting there that we haven't yet seen, especially regarding food prices and energy prices when it comes to inflation. And that's going to put further pressure for interest rate rises if inflation does rise over and above what the analysts and the bankers are expecting. So I see inflation in 2023, especially in the first half in the US, running at around about the 8.5% to 9%. I was calling double-digit inflation, but I've lost a little bit of a nerve on that one. We could be talking 8.5%, 9% on inflation in the US. And I do expect interest rates, by the way, in the US to peak around about 7% by July 2023. Moving on to cryptos, moving on to bitcoins. Well, the crypto sector is going to be under pressure. It's going to continue to be under pressure for several reasons. One, high interest rates, high inflation, and the biggest factor is the confidence in the sector. The confidence in the sector has been knocked dramatically by the collapse this year of lots and lots of platforms. The biggest recently being FTX, which went bust, and Sam Bankman-Fried is now being called into Texas court to explain and justify what the heck went on with FTX. That's also an interesting one to keep an eye on. Let's get the sun out my eyes. Okay. Another one, Gemini platform, also knocked confidence. That's also filed for bankruptcy, or going to file bankruptcy, and also BlockFi. So there's been a lot of rumors out there regarding cryptos. Bitcoin did creep up above 17,000. I don't think it's really going to go anywhere as far as Bitcoin's concerned. I think it just looks like an absolute sell. Remember, today in about half an hour, you've got the non-farm payrolls. The number is expected to be around about 210,000. If it comes higher than that, you'll see a sell-off in equity markets, because that would be another indication of a very strong economy with full employment and likely to feed into inflation numbers in the future. However, a good employment number also is good for retailers, because the retailers and consumer side show there's appetite there by the consumer sector to keep on spending money, and that's good for the retail sector and the corporate sector. Regarding opportunities of buying, selling, I'm looking at things like Amazon, Tesla, Meta and Apple, as I've said all along, continues to look like a sell. They look overpriced. I think we're in, and I do believe in my opinion, that we're in for some significant shocks coming January. So this market looks like a market to sell into, not necessarily to buy into, because it does look a bit overbought, or a lot overbought at these levels. Okay, oil is crept up a little up yesterday. OPEC is going to cut production, probably keep the oil there at $100 a barrel. We can't see oil going down much lower. OPEC won't allow it because they need to be $100 a barrel in order to make money. That's more or less it. You can share, subscribe, comment, you can connect, you can look on my Instagram. I want to build up the audience, so get it out there. Meir Volensky with Driving Markets. Have a good day.